There is something strange about gold, and almost nobody talks about it correctly. You'll hear people say it's up. You'll hear people say it's down. You'll hear it called a safe haven one week and a relic the next. And through all of that noise, the metal itself just sits there, silent, ancient, indifferent to the argument swirling around it. But that silence is exactly the problem. Because while everyone is busy watching whether the price ticked higher or lower today, they're missing what gold is actually doing. And what it's doing right now underneath the surface is telling a story about your money that very few people are prepared to hear. Here's the contradiction most people can't resolve. On the surface, gold often looks weak. It stalls. It pulls back. It disappoints the people who expected it to shoot straight up. It gets dismissed as an old-fashioned asset that doesn't pay interest, doesn't build anything, doesn't do much of anything except sit in a vault. And so people look at it, shrug, and move on. But the people who study the deep machinery of the financial system, people like Ray Dalio, who built the largest hedge fund in the world by understanding how money and debt actually behave over long stretches of history, are looking at the very same gold and seeing something almost opposite. They're not watching the price. They're watching what the price is reacting to, and that difference in what you're looking at changes everything. So the real question tonight isn't, is gold going up or down? That's the surface question, and it's the wrong one. The real question is this: what is gold measuring? Because if you understand what it's actually measuring, then weak on the surface and something happening underneath stop being a contradiction. They become the same sentence. Let's start with the explanation almost everyone accepts, because you have to understand the surface story before you can see through it. Most people, when they think about gold, think about it as an investment you speculate on. It's a thing you buy hoping the number goes up. In that frame, gold competes with stocks, with real estate, with everything else you might put money into, and you judge it by one measure. Did it make me money this quarter? And by that measure, gold is often frustrating. It has long stretches where it does nothing. It doesn't pay you dividends. It doesn't pay you interest. So compared to an asset that quietly pays you while you hold it, gold can look lazy. It can look weak. That's the surface. And the surface isn't wrong exactly. It's just answering a small question while a much bigger one goes unasked. Because here is where the deeper lens begins, and this is the reframe that changes how you'll see everything that follows. Dalio's core argument, one he's made consistently and in plain language, is that gold isn't really a commodity at all. Gold is money. It's the oldest money there is, valued across thousands of years and across nearly every country that has ever existed, while almost every paper currency ever created has come, weakened, and eventually gone. And once you make that single shift from seeing gold as a thing you buy to seeing gold as a form of money that competes with the money in your wallet, the entire picture reorganizes itself. Because now gold isn't a lazy investment sitting still. Now it's one currency being measured against another. And when you watch one currency against another, a whole different question opens up. Not, is gold strong, but compared to what? When people say gold is weak, what they usually mean is that it's weak, measured in dollars, on a particular day, in a particular mood of the market. But if gold is money, then its price is not just telling you about gold. It's telling you about the dollar. It's telling you about every paper currency it's being priced in. Gold going up over long periods isn't really gold getting more valuable. It's the money you hold quietly losing value against something that can't be printed. And that reframe is uncomfortable because it means the thing you thought was the stable measuring stick, your own currency, is actually the thing that moves. Gold isn't the needle jumping around on the scale. Gold is closer to the weight that doesn't change, revealing that the scale itself has been drifting the whole time. Now, why would the scale drift? Why would money you trust quietly lose ground to a metal that does nothing? This is where we go one layer deeper, and to the reason any of this matters. And the reason is debt. Throughout history, Dalio points out, every monetary system has run into the same wall. Governments and economies build up enormous piles of debt, promises to pay, stacked higher and higher over years. And eventually, the debt grows larger than the amount of real money available to service it comfortably. When that happens, there are really only two ways out, and both of them run straight through your savings. A system can hold the line, refuse to create new money, and let the debts default, which historically produce brutal deflationary collapses. Or it can do the other thing, create more money to keep the promises flowing, print its way through the pressure, and in doing so, quietly reduce the value of every unit of that money already in existence. And here's the historical pattern Dalio keeps returning to. Since central banks became the norm, systems under this kind of pressure have consistently chosen the second path. They print. They don't default outright. They devalue instead. Sit with what that means, because this is the hinge of the whole story. When a system under debt pressure chooses to create money rather than default, the debt doesn't vanish. The cost of it gets transferred, spread silently across everyone holding that currency. It doesn't arrive as a bill in the mail. It arrives as the slow erosion of what your money can buy. And in exactly those conditions, too much debt, and a system leaning toward printing rather than breaking, gold has historically done what it always does. It holds its ground while the paper money slips. Not because gold suddenly became more useful, but because it's the one form of money that can't be created out of thin air to solve someone else's debt problem. You can print dollars. You can print euros, yen, any currency ever invented. You cannot print gold. And that single stubborn fact is why, across thousands of years, it has kept its footing while paper monies came and went. So now go back to the surface story and watch it dissolve. When gold looks weak on a given day, that can simply mean the pressure hasn't broken through to the surface yet. The debt is building, the strain is accumulating underneath, but the price is calm because the market's attention is elsewhere. Weak on the surface, something happening underneath isn't a paradox at all. It's a precise description of exactly the moment Dalio spends his time studying, the quiet part of the cycle when the pressure is real but not yet visible, and the people watching only the price feel reassured while the people watching the system feel the opposite. Let me make this personal, because so far this could sound like a story about governments and central banks, distant, abstract, someone else's problem. It isn't. The person who feels this most is the careful saver. Think about what saving actually is. You take the value of your effort, hours of work, years of discipline, and you store it in a form of money, trusting that the value will still be there when you need it. That trust is the entire foundation of a savings account, a retirement plan, a pension, a fixed income. It all rests on one silent assumption, that the money you set aside will hold its value across time. But if the system's response to too much debt is to quietly reduce the value of that money, then the saver is precisely the person carrying the cost. You did everything right. You didn't gamble. You didn't overspend. And yet the value can leak out of your savings without you ever making a single mistake, because the erosion happens to the money itself, not to your behavior. That's the cruelty of this particular risk, and it's why it goes so widely ignored. There's no moment of loss you can point to. Nobody takes anything from your account. The number on your statement can stay the same or even rise while the value underneath it thins out. And because there's no dramatic event, no crash, no red screen, most people never connect the growing sense that my money doesn't go as far as it used to with the deep machinery that's actually causing it. They feel the symptoms. They never see the cause. And gold, quietly, is one of the few places where that cause becomes visible, if you know how to read it. Now here's the layer that most explanations never reach, the one that separates genuinely understanding this from just being worried about it. Dalio argues that gold has one more property that ordinary money doesn't, and it becomes most important in exactly the worst moments. Gold, he points out, is unusually hard to take. Every other form of money you hold depends on someone else honoring it. A bank, a system, a promise, a payment that has to come from somewhere else to give it value. Gold doesn't. It can be held directly. It can't be erased in a cyber attack. It doesn't depend on a counterparty staying solvent or a government staying cooperative. And so, in history's most stressed moments, financial crises that led to heavy taxes and confiscatory policies, or economic and monetary conflicts between nations where money itself became a weapon through sanctions and freezes, gold behaved differently from everything else. It wasn't just a store of value. It was a store of value that was hard to reach into and take. That's a very different kind of asset than a number in a system you don't control. And this is where the present moment gets its weight, though we have to speak carefully here, because certainty is exactly what a serious narrator should refuse to fake. What Dalio has been describing in recent years is a world with an enormous amount of debt, systems that lean toward creating money rather than defaulting, and rising tension between major powers where money and reserves are increasingly treated as instruments of strategy. He noted that gold has quietly become one of the largest reserve assets held by central banks in the world, that the institutions running the paper money systems are themselves holding meaningful amounts of the one money they can't print. Think about what that quietly tells you. The very entities that create currencies are, at the same time, holding the ancient money that stands outside all of them. That's not a small detail. That's the system hedging against itself. But, and this matters, none of this is a prediction of a date or a promise of an outcome or a signal to rush out and do anything specific. Dalio himself is careful about this in a way most commentators aren't. He talks about gold not as a bet you place, but as a form of money you hold some of, as a matter of basic diversification, the same way you'd hold some cash, not because you're certain of what's coming, but because you're honest about the fact that you're not. His framing is almost the opposite of urgency. It's the calm recognition that no single form of money is guaranteed to hold its value through every possible future, and that spreading that risk is simply prudent rather than dramatic. The people who understand gold best treat it least like a lottery ticket. They treat it like insurance you never need to lean on. So let's return to the surface one more time now that we've been underneath it, because the whole point of this was to change what you see when you look. When you hear that gold is weak, you now know to ask the questions that were hidden before. Weak measured in what? Weak on the surface, while what accumulates underneath? Is this the quiet part of the cycle, where pressure builds without breaking through, or the loud part where it finally does? You're no longer watching the price. You're watching a signal, and a signal that looks weak is not the same as a signal that's telling you nothing. Sometimes the most important message is the one being sent quietly, in a language most people never learn to read. And this is the deepest term, the reframe I've been building toward this entire time. What gold really measures, in the end, is trust. Not shininess, not scarcity for its own sake, but trust, the world's confidence that the paper money it holds will keep its value. When that trust is strong, gold can drift and look uninteresting, because there's no reason to reach for an alternative to money that's working fine. When that trust begins to quietly erode, when debts pile past what can be comfortably serviced, when systems lean toward printing, when the stability everyone assumes starts to feel less certain, gold begins to matter again, often before the surface shows any drama at all. So when gold looks weak on top but something is stirring underneath, what you may be watching is the very early quiet stage of trust beginning to shift. And trust, once it starts to move, tends to move slowly and then all at once. That's why the people who study this don't watch gold the way most people do. They're not asking whether it made them money last month. They're using it as a kind of instrument, a gauge on the dashboard of the entire monetary system, measuring a pressure you can't otherwise see. And a gauge doesn't have to be exciting to be important. A quiet gauge can be the most important thing in the vehicle, precisely because it's telling you about a pressure building somewhere you can't see directly. So here's what I'd leave you with, not as advice, but as a way of seeing. The next time you hear that gold is weak, resist the reflex to dismiss it. Ask what it's being measured against. Ask what's happening to the money it's priced in. Ask whether the calm on the surface is genuine stability or just the quiet before a shift that hasn't reached the price yet. Because the great mistake isn't holding gold or not holding it. The great mistake is watching the wrong thing entirely, staring at the price while the actual message plays out underneath, in a signal you were never taught to read. The surface will always be loud. It will always give you a number and a headline and a reason to feel one way or another today. But the things that never lifetime money, debt, trust, the slow erosion of value, the quiet decisions of the institutions that run the system, those rarely announce themselves on the surface. They move underneath patiently until one day they don't. And the people who come through those moments with their footing intact are almost never the ones who reacted fastest to the headlines. They're the ones who learned long before it mattered to look beneath them. Gold, weak as it may look on any given day, is one of the oldest places that a deeper story has ever been told. The only question is whether you're reading the surface or what's happening underneath.